There's something happening in the gold market right now that, according to every traditional rule of finance, should not be possible. And I don't say that lightly. I've been analyzing precious metals markets for years, and what we are watching unfold in real time is the kind of thing that gets written about in financial history books. The kind of event that, when you look back on it years from now, you'll either say, I saw that coming and I positioned myself accordingly, or you'll say the most expensive words in the English language, I should have paid attention when I had the chance. So stay with me here, because I'm going to show you exactly what this is, why it matters, and most importantly, what the smartest money on the planet is doing about it right now. Let me start with a number. Gold is sitting at roughly $4,460 per ounce. Take a breath and let that sink in. Now, a year ago, just 12 months ago, gold was trading at around $3,300 an ounce. That means gold has delivered more than 34% returns in a single year. Year over year, 34%. Meanwhile, your savings account is still sitting there offering you what? 4%? Maybe 5% if you hunt around? The stock market threw a tantrum 3 times in the past 12 months that would have aged you 10 years if you were paying attention. But here's what makes this story genuinely extraordinary. And I mean extraordinary, in a way that has our entire research team running numbers we've never had to run before. Gold hit an all-time high earlier this year of $5,608 per ounce. In fact, it blew past every resistance level that every analyst, every trading desk, every chart technician had mapped out. And it kept going. It didn't pause at 4,000. It didn't pause at 4,500. It didn't pause at 5,000. It just kept climbing, like it was operating by a completely different set of rules. And then, and this is the impossible part I'm talking about, it pulled back. It corrected down from those all-time highs to where it sits today, around $4,400. And now here's the question that every serious investor, every retirement planner, every central banker in the world is wrestling with right now. Is this pullback a sign that the gold bull market is over? Or is this one of the most significant buying opportunities in the last decade? I'll tell you what the data says. But first, quick note, and I'll keep it brief. If you're watching this and you're near retirement or already in retirement, I've put together a completely free guide in the description that outlines exactly how thousands of American retirees are using saving strategies to protect the wealth they've spent a lifetime building. No cost, no commitment, just the information. Link is down below. Check it out when you're done here. Now, let's talk about what's really going on. To understand why what's happening right now is technically impossible, according to the old playbook, you need to understand what the old playbook said. For decades, the conventional wisdom on Wall Street went something like this. Gold goes up when interest rates go down. When the Federal Reserve raises rates, gold suffers because suddenly bonds and money market funds start paying you real yield. Gold doesn't pay a dividend. It doesn't pay interest. So why hold it when you can park your money in a treasury and collect a coupon? That was the rule. That was the framework. That was the model. Every quant fund, every hedge fund, every institutional money manager used to position their gold exposure. High interest rates equals lower gold. Period. End of conversation. Except something strange happened starting a few years ago. The Federal Reserve hiked rates at the fastest pace since the 1980s. the most aggressive rate hiking cycle in 40 years. And gold, instead of collapsing like the textbook said it should, gold went up. Not a little, not a statistical anomaly. Gold went from the low 2000s all the way to now over $4,000 through one of the most aggressive rate hiking environments in modern history. The old model is broken. The old correlations don't hold. And if you want to understand why, if you want to understand what is actually driving gold right now, you have to look past the surface level analysis that most financial commentators give you. You have to go deeper. Let me take you there. Start with the central banks, because this is where the real story begins. And it's a story that the mainstream financial media has been criminally slow to connect the dots on. Central banks around the world, the official institutions that manage the monetary reserves of entire nations, bought 244 metric tons of gold in the first quarter of this year alone. Let that number land. 244 metric tons in 3 months. That's a 17% increase from the previous quarter and the fastest pace of accumulation we've seen in over a year. And who's buying? Poland, Uzbekistan, China, India, emerging market nations that for decades held the bulk of their reserves in U.S. Treasury bonds. The so-called safe asset, the bedrock of the global financial system. These nations are now actively, methodically, and very deliberately moving their reserves away from dollars and into gold. Now, stop and ask yourself a critical question. Why would Poland's central bank buy gold? Poland doesn't mine meaningful quantities of gold. There's no Polish gold rush happening. Poland's central bank is buying gold because Poland's central bank has looked at the state of the global financial system and concluded that holding physical gold is safer, more sound, and more strategically valuable than holding a piece of paper issued by the United States government. When the central banks of sovereign nations start making that calculation en masse, and they have been making it for 3 straight years now, that is not a trade. That is not speculation. That is a structural shift in the architecture of global finance. And structural shifts don't reverse easily. They don't reverse quickly. They play out over years and decades, and they move asset prices in ways that look impossible until suddenly they look inevitable. Here's another dimension of this that doesn't get nearly enough attention. Global central banks now collectively hold roughly $4.7 trillion in gold reserves. $4.7 trillion, and central bank demand has gone from a relatively minor factor in the gold market to now representing more than 50% of total demand. More than half of all the gold being bought in the world today is being bought by central banks. Think about what that means for price dynamics. When the marginal buyer of an asset is a central bank, an institution that is largely price insensitive, that is buying for strategic, not speculative reasons, that doesn't have a stop loss, that doesn't face margin calls, that isn't going to panic sell because the price dropped 5% on a Tuesday. When that's your marginal buyer, the price support dynamics change completely. You get a floor under the market that is structural rather than speculative. That's part of why the pullback from the all-time high has been relatively contained. The central banks were there to catch it. But wait, there's a layer beneath the central bank story that goes even deeper, and this one involves geopolitics in a way that should frankly alarm anyone who isn't paying attention. You've probably heard the term de-dollarization thrown around. Maybe you've heard it in the context of BRICS nations, Brazil, Russia, India, China, South Africa, and the expanding coalition of countries now aligned with that bloc. But I want you to understand what de-dollarization actually means in practice, because it's not abstract, it's not theoretical. It's happening right now in the real world, in real transactions, in real economic agreements, and it has direct, measurable, quantifiable implications for gold. The U.S. dollar's status as the world's reserve currency was essentially cemented at the Bretton Woods Conference in 1944. Coming out of World War II, America was the dominant economic and military power, and the world agreed that global trade would be conducted in dollars. Oil, commodities, agricultural products, technology, everything gets priced in dollars. And because everyone needs dollars to buy the things they need, there is constant demand for dollars around the world, which allows the United States to do something no other country on earth can do. We can print money and export the inflation to everyone else. That arrangement served American interests extraordinarily well for 80 years. But it required something in return. It required that the rest of the world trust the United States not to abuse the privilege, to keep the dollar sound, to maintain fiscal discipline, to not weaponize the currency system for political ends. And then, in the aftermath of Russia's invasion of Ukraine, the United States and its allies froze $300 billion in Russian central bank reserves. Just froze them overnight, seized assets that a sovereign nation had accumulated over decades. Now, regardless of your view on the geopolitical situation in Eastern Europe, understand what signal that sent to every other nation in the world that holds dollar reserves. Your assets are not safe. Your dollar holdings can be seized if Washington decides it doesn't like your government's policies. That moment, that decision, accelerated de-dollarization faster than any geopolitical analyst had projected. Because suddenly the question wasn't theoretical anymore. Every emerging market central bank, every BRICS-aligned nation, every country with a complicated relationship with American foreign policy looked at that and said, we need an alternative. We need to hold something that cannot be frozen, something that cannot be seized with a phone call, something that exists outside the dollar system entirely. The only asset that fits all of those criteria, the only store of value that has zero counterparty risk, that cannot be frozen, that exists completely outside any government's ability to confiscate remotely, is physical gold. Now I want to take you back in history for a moment, because understanding what happened in 1971 is essential to understanding what's happening today. On August 15th of that year, President Nixon went on national television and announced something extraordinary. He announced that the United States was suspending the convertibility of the dollar into gold. This was the final unraveling of the Bretton Woods system, the end of the gold standard. Up until that moment, every dollar in circulation was technically backed by gold. $35 could be exchanged for 1 ounce of gold. The amount of money that could be printed was constrained by the amount of gold in Fort Knox. It was a system that forced fiscal discipline. You couldn't just print money endlessly because every dollar you printed had to be backed by a real, physical, finite commodity. When Nixon cut that link, when he severed the connection between the dollar and gold, he unleashed something that has been compounding ever since. Freed from the constraint of gold backing, governments around the world discovered they could finance spending by printing money. Deficits could be run indefinitely. Debt could be accumulated without limit. Just print more dollars. Just issue more bonds. What happened to gold after 1971? It went from $35 an ounce to $850 an ounce by 1980. That's a 2,300% increase in less than a decade. Not because gold changed. Gold is the same metal it's always been. Gold doesn't rust. It doesn't corrode. It doesn't lose its properties. What changed was the dollar. What changed was the monetary system. And gold, in its price, simply told the truth about the dollar's declining purchasing power. Now we have to ask ourselves, if gold went up 2,300% in the decade after the world went off the gold standard, what happens to gold in the decade after the world goes off the dollar standard? Because that is the question we are living through right now. Not theoretically. Not in some distant future scenario. Right now, in this moment, the global monetary system is in the process of a structural transition away from dollar dominance. And gold, as it has done every single time in recorded human history, is reflecting that transition in its price. Look at what happened in 2008. Another defining moment for gold that most people didn't interpret correctly in real time. The global financial system nearly collapsed. The housing market, the asset that was supposed to be the safest investment in America, the foundation of middle-class wealth, turned out to be built on a mountain of fraud and leverage. Lehman Brothers collapsed. Merrill Lynch had to be rescued. AIG, one of the largest insurance companies in the world, was hours from failure when the Federal Reserve stepped in. And how did the Fed respond? It launched quantitative easing. It printed money at a scale that had never been attempted in American history. The Fed's balance sheet went from $900 billion to over $2 trillion in the course of just a few months. More money, created from nothing, injected into the financial system. Gold went from around $800 an ounce in early 2008 to over $1,900 an ounce by 2011. More than double in 3 years. People who understood what quantitative easing actually meant, people who understood that printing money is ultimately inflationary, positioned themselves in gold and watched their wealth multiply, while everyone else was still trying to understand what a mortgage-backed security was. But here's the thing about 2008 that makes today even more dramatic. In 2008, the Federal Reserve's response was unprecedented. It shocked the market. Printing $2 trillion was considered an extreme emergency measure. Today, the Fed's balance sheet has been as high as $9 trillion. The emergency measure of 2008 became the standard operating procedure of the next 15 years. The monetary system didn't go back to normal after 2008. It just kept expanding. The money printing didn't stop. It became institutionalized. And now, here we are. The cumulative effect of decades of deficit spending, monetary expansion, and financial engineering has created a situation where the debt levels of developed nations, including the United States, are so large, so structurally embedded, that there is no politically viable path to paying them back through conventional means. The only realistic option is the same option that governments have chosen throughout all of recorded history when debt becomes unmanageable. Inflate it away. Print the money. Devalue the currency. Make the debt cheaper in real terms by making each dollar worth less. This is not speculation. This is not a doom and gloom conspiracy theory. This is simple mathematics. You can look at the trajectory of national debt. You can look at the trajectory of unfunded entitlement obligations. You can look at the trajectory of interest payments on that debt, which now consume a larger percentage of the federal budget than at any point in modern history. The numbers do not lie. And every single time in history that a country has found itself in this situation, ancient Rome, Weimar Germany, Venezuela, Argentina, the outcome has been the same: currency debasement and the destruction of purchasing power for people who held their savings in that currency. Gold doesn't debase. That's the fundamental truth that sits underneath everything I'm telling you today. Gold cannot be printed. Gold cannot be created by a committee decision in Washington. Gold is finite, it's durable, it's globally recognized as a store of value, and its supply increases by only about 1.5% per year, no matter what central bankers decide to do. That scarcity, that fundamental geological physical scarcity, is why gold has been the ultimate store of value for 5,000 years of human civilization. Not because of tradition, not because of superstition, because of math. Now let's talk about what's happening on the supply side of the equation, because this is another dimension that almost nobody is talking about, and it's adding jet fuel to everything I've just described. Gold mine production has been essentially flat for nearly a decade. Finding new major gold deposits is increasingly difficult and expensive. The grade of ore being mined, meaning the concentration of gold per ton of rock, has been declining for years, as the easy deposits have been exhausted. Mining companies are having to dig deeper, use more energy, and process more rock to produce the same amount of gold they were producing a decade ago. Supply is constrained in a way that is structural, not cyclical. Meanwhile, demand, as I've just described, is going through the roof. Central banks buying at record pace, retail investors in Asia, particularly in China and India, buying physical gold at levels that are staggering. Q1 of this year saw global gold demand hit a record high of 1,231 tons, valued at $193 billion. Bar and coin purchases alone surged 42% year over year, not percent above trend, 42% year over year. When you have constrained supply meeting explosive demand, there is only one direction prices can go, and every economist since Adam Smith has understood this. Let me add one more layer to this picture, and this one involves mechanics most people have never heard of. But that directly impacts the price you see when you look at gold on your phone. The London Bullion Market Association of the LBMA is the world's largest gold trading market. More gold changes hands in London every single day than exists in the vaults of the United States government. But here's the thing. Most of that gold doesn't actually exist. It's paper gold. It's contracts and promises and accounting entries that represent claims on gold that, if everyone tried to redeem it once, could never actually be honored. The ratio of paper gold to physical gold in the system has expanded dramatically in recent years. There are estimates that suggest for every ounce of physical gold that exists, there are somewhere between 30 and 100 paper claims on that gold. 30 to 100, and as long as everyone operates on the assumption that they don't actually want delivery, the whole system works fine. But when confidence cracks, when people start actually demanding physical delivery of the gold they think they own, that's when the paper market gets into serious trouble. We've already seen glimpses of this. There have been periods where the spread between the COMEX futures price and the physical spot price widened dramatically, a signal that the market was pricing in real uncertainty about physical delivery. The drain on COMEX gold vaults over recent years has been notable. Physical gold has been flowing from west to east at a rate that concerns people who understand what it means. Now, here's something I want you to think about carefully. If you hold your gold exposure through a paper product, an ETF, a futures contract, a gold certificate, you are participating in that paper system. You have a claim. You have a promise. But in a true financial crisis, in the scenario where the paper market comes under stress, the value of that promise may not equal the value of physical metal. The whole point of gold as a crisis hedge is that it's real, it's tangible, you can hold it, and you need to make sure what you own actually reflects that reality. Speaking of protecting yourself from what's coming, I want to take just a moment here because this is important for a specific group of people watching. If you've spent your career building a retirement account, a 401k, an IRA, a pension, and you're watching all of this unfold and thinking, how do I actually put real gold, physical gold, into my retirement account without creating a tax nightmare? I've got a free guide in the description that lays out exactly how gold IRAs work. It covers the mechanics of rolling over an existing retirement account into a structure that holds physical gold, the rules around it, what it actually looks like to have real metal backing your retirement. Whether you're looking to hedge against a market collapse, protect against continued dollar devaluation, or just build some genuine diversification into what you've spent your life accumulating, it's worth the 10 minutes to read through it. Link is in the description. Now, let's pull back and talk about the technical picture, because the chart tells a fascinating story right now. And if you understand how to read it, it paints a very specific picture about where we go from here. Gold's all-time high of over $5,600 hit earlier this year. It was a parabolic move, the kind of move that doesn't typically end at the first pullback. In technical analysis, there's a concept called the Fibonacci retracement, a mathematical relationship that describes how assets tend to pull back after major moves before resuming their trend. The key retracement levels from gold's most recent leg up suggest that the current pullback to the 4,400 range is actually a textbook healthy consolidation. It's not a breakdown. It's not a trend reversal. It's a market catching its breath before the next leg. The key support levels that technical traders are watching sit around $4,200. If gold can hold above that level, and everything I've described about fundamental demand suggests there's enormous buying interest below current prices, then the technical setup for the next move higher is very compelling. J.P. Morgan has a price target of $5,000 by year end. Goldman Sachs is at $5,400. Wells Fargo has put out projections above $6,000.